One, we're going to talk about the capital adequacy standards, right? What do you mean capital adequacy? Um, well, it's about the bank's stability, right? Capital adequacy refers to the amount of equity capital and other securities a bank holds as reserves. Reserves. What is that? Reserves, right? Um, well, what's the idea over here? Right? What's the idea over here? I have my whiteboard here. So I'm going to talk to you by drawing pictures. Can you see it? All right, over there, right? So here, let's see. Um, I should. Okay, like this. Okay. All right. So, um, okay. All right. So the bank, right? Bank is a company and it also has a balance sheet, which is awfully boring. I know this is boring and sleepy, but don't sleep. I'm gonna check you, right? Bank balance sheet. Why is it boring? Because there's nothing real, okay? Real business, no product like this on the balance sheet, but all money, right? So, on your asset side, what do you have? Well, you have loan, loan, dollar amount. You lend your money to corporations like Samsung Electronics or Apple or whatever, right? Netflix kind of companies. You lend your money. Okay, can you see it? Wait. Da, da, da. Yes, I have to increase the right. Good. So loans. Okay, you lend your money to the corporate clients. Okay, and then on your liability side, what do you have? Liabilities. Over here you have deposits, dollar amount. People have to come to you with money deposited. Okay, that is your obligation. Okay, as a banker, you have to pay these guys whenever, at random time. Whenever they come to the counter and say, I want my money back, and you have to give them money back. So that's liabilities. Okay? This is your investment. Okay? With the depositor's money, okay, you invest in their, how do you say, business as a creditor or banker. Loan exposure, you make it. Okay? So money goes from here to there, right? Not just that, but you have equity investment in the first place. Okay? To start a banking business, you need to put your own money. Without that, who will trust you and then put their money as a deposit in the first place, right? So you need to put your equity capital first. Okay? And then collect deposit. Together with it, you lend money to Samsung Electronics or Samdasu company like over here, right? So that's basic structure of balance sheet. Okay? But that's not the end. Okay? Here, okay, let's say your 100% of your business is loan business. Okay? The thing is, depending on the business cycle, this market value of loan or the value of loan, okay, will fluctuate. What do you mean? If the guys, the Samsung Electronics, go bankrupt, then they cannot repay the loan to you. So the value of loan, even though it started as this much, okay, as the company or the borrower goes bankrupt, your value of loan will shrink down. Make sense? So in boom time, you don't have to worry about it. Economic boom, everybody is doing their good business. But in crisis like COVID-19, like these days, right? You're in trouble as a banker because the borrowers go bankrupt. They cannot repay the debt, especially in the short run. Month by month repayment, interest, or principal, they would have to miss it. They are in trouble and you are in trouble subsequently. So the value of loan decreases. Why are you in trouble? You are a banker. Why are you in trouble? Because of depositors. When do they come? I don't know. God knows when. And random time they will come, right? But what is the rule? What is the law? You have to pay them whenever they come to the counter and say, I want my money back, right? If your loan value is below this deposit value that you owe, you're in serious trouble. Okay? That's capital, how do you say? Your bank will be delinquent, or capital is inadequate, right? Essentially your bank will be bankrupt, and there will be a lot of bank runs, right? People will run to your bank and you will collapse, right? Before that kind of things happen, right? By the way, before that kind of things happen, okay? So what do you want to have? Right? You want to have enough of equity capital, okay, to protect your depositors, right? To protect your depositors, you need to have enough capital buffer. Okay, buffer means like if you're driving cars, it's like bumper, pamba, and then you have to have enough of this buffer before it crushes the depositor's value. That's the idea. Capital adequacy. Interesting, right? Okay, good. So the equity works as a buffer capital. And how much enough of capital do you have is a key issue in talking about banks healthy, bank stability, right? So that is a key issue we're going to talk about from now on, okay? For that purpose, right? Right. What kind of items over here and there are treated as buffer capital is an issue, okay? Is a key, a very interesting issue. The thing is, on the equity side, you have a handful of items, which is common equity, okay, and then retained earnings, you know what retained earnings is. You know, in income statement, after making revenues, and then you expense out, right? And then you get profit before tax, and then you pay tax and get net income, and then the part of it is paid out as dividend, and the remaining part goes into retained earnings, and it gets accumulated, right? And then with this amount you reinvest to your day-to-day business, right? So that's retained earnings, common equity. And then there are other kinds of equity, which is preferred stock. I use different color because this will be a different category later on, okay? I'm trying to focus on which works as a core capital, and then versus which works as a buffer capital as well, but in lesser important ways, okay? Which could be, additional things, so some supplementary things. Preferred stock, kind of a supplementary thing. Also, when you look at the liability side, so my dog is barking over here, right? So I have to stop in a minute. Come on. All right. So in liability side, okay, I highlighted deposit as the most important debt that you have to repay, right? Don't touch that. But you have other additional liabilities in this balance sheet. What do you have? Well, typically you have some corporate bond issued. Okay, corporate bonds. Bank of America, your Bank of America, okay, to do your business, you not only have equity invested from shareholders' pocket, but also you go to the bond market and then issue bond to raise capital. Okay, raise capital for your own business. That's corporate bond. And this bonds, okay, has some range of categories, okay, but there is some priority nature in it. Okay, some corporate bonds have more priority, and some corporate bonds have less of a priority. Okay, to the debt holders who holds this corporate bond, okay, some bonds have prior claim. How do you say claiming priority? And the other kind is called subordinated debt. Subordinated bonds, right? Out of this subordinated bond, we call it sub-debt. Okay, sub-debt. Their priority as the creditor is way below. Okay, so when your bank goes bankrupt, you have to repay those debts to depositors first, and then the next claimant will be senior debt holders, right? Senior debt holders, they have the first claim relative to these guys after depositors. And if you hold sub-debt, subordinated bond, least amount of chance. The law says that you have lower priority. Okay, lower priority. So sub-debt kind of things, together with preferred stock, they are perceived as a buffer capital. You can sacrifice them in a plain and brutal way of saying. You can sacrifice them. Okay? Yeah. So 2 layers of capital buffer, you can think about it. All right? So we're going to talk about this concept in the next section.